There are two radically different ways to scale a modern company into a massive valuation. You can either build a world-class assembly line of physical or digital products, or you can turn your corporate treasury into a high-leverage financial engine. Most investors still follow the traditional rules of the game. They use metrics like the Sharpe ratio and beta to find stability, operating under the assumption that low volatility is the only true measure of safety. However, a specific cohort of companies is now bypassing that growth curve entirely. By aggressively restructuring their operations and capital, these firms have managed to multiply their market valuations five-fold in a few short years, a phenomenon labeled as quintuple value appreciations. Look at the results of AppLovin and MicroStrategy. AppLovin is currently generating staggering amounts of liquid cash, while MicroStrategy recently survived a catastrophic $12.5 billion quarterly loss. Comparing these two companies reveals a transition in how we define a business. Corporate worth is increasingly a function of financial engineering. The product being sold often matters less than the capital structure supporting it. AppLovin is a masterclass in operational engineering. They achieved this by ruthlessly shedding deadweight, making the strategic decision to divest their entire portfolio of non-core gaming apps. This exit allowed management to focus every dollar of research and development on their high-margin growth engine, the Axon AI advertising platform. This chart shows the immediate impact of that focus. In 2025, AppLovin's revenue hit $5.48 billion, a 70% increase in a single year. Because their AI platform requires very little overhead to scale, that revenue converted into pure liquidity. They ended the year with $3.95 billion in free cash flow. Management used that cash as a weapon. They funneled $2.58 billion directly into share repurchases, effectively shrinking the supply of stock and driving up the value for remaining holders. They are now doubling down on this momentum, using new generative AI tools to expand their advertising reach into the global e-commerce market. AppLovin represents the peak of traditional corporate success, building a superior technology that generates undeniable, massive cash profits. Then there is MicroStrategy. Under Executive Chairman Michael Saylor, the company has pioneered an entirely different path: capital engineering. Instead of focusing on software sales, they converted their corporate balance sheet into a massive Bitcoin treasury. This move was designed to decouple the company's valuation from traditional macroeconomic trends. This strategy relies on a reflexive feedback loop, a financial mechanic that generates value out of the company's own stock price. This diagram maps how that cycle works. When the stock trades at a premium, MicroStrategy issues new shares and debt, uses the proceeds to buy spot Bitcoin, and increases the Bitcoin per share ratio. This makes the stock more attractive, which pushes the price up and starts the loop all over again. To fuel this machine, they created a unique preferred stock instrument called STRC. This acts as an $8.5 billion digital credit stabilizer, allowing the company to raise capital even when the crypto market is stagnant. But high leverage creates extreme volatility. In the first quarter of 2026, dropping Bitcoin prices forced the company to report a $12.5 billion hit. At this scale, MicroStrategy behaves less like a software vendor and more like a financial instrument designed to manipulate capital structure for exponential gains. These two companies represent the two end states of modern wealth. AppLovin proves that the future can be built through flawless AI execution, while MicroStrategy proves that market value can be engineered through a balance sheet. This forces us to reconsider what we actually mean by risk. When the global economy shifts, it's unclear which of these models will prove to be the safer harbor. Every modern investor has to decide: do you bet on a company's operational cash flow, or do you bet on its financial architecture and crypto leverage? In this market, a rising stock price is just a number. You have to look under the hood to see if the engine is powered by real cash profits or dangerous financial leverage.